Hello and welcome to the Morning Bell for Friday, August 8th, 2025. I am Keith Harwood here for Tradespoon and Yellow Tunnel. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are non-investment advisors, not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, the presenter of this video, myself, and the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. So please keep that in mind as you evaluate anything that we discuss for your own personal investment and trading portfolio suitability. And with that, we're off. It's been an interesting, maybe starting trend to go for at least the next couple of days. Yesterday, we had firm open and then selling into the close, or selling throughout the day and then a little buying into the close. So started talking through that a little bit yesterday at the closing bell. And what it seems to me is that we've got a situation where we're looking for a reason to go to a new high and we just don't see it yet. That said, there is still interest in investing in the market and buying dips, and we're not really seeing dips. So people just say, well, I guess I can buy anyway. We do have some fundamental inputs that make people excited about certain stocks, Apple being one of them now that they don't have to do the made in the United States full-blown iPhone. And generally, some of the biggest themes, I think, of the last year or so, like AI, for example, that still seems to be working for the market. Palantir continues to be bullish. Some of the more AI-focused other companies like Microsoft and Meta, some of the AI-focused semiconductor names like NVIDIA is still firm, but it's not a buy every semiconductor name, not buy every tech name, certainly not buy every small cap name. Healthcare, very weak. Eli Lilly, United Healthcare, really poor earnings. Johnson & Johnson seems like the only thing that goes up within that space. And then, of course, financials as a sign of the economic health of the United States, kind of consolidating here. So we've got a stock pickers market that anytime that stock picking and focus on maybe some of the big tech that's working, Apple, or whether it's an Apple, a Microsoft, a Meta, Palantir, whatever, starts to get the market too close to highs, then we see some selling because we're hitting resistance and we're getting close to it. Who's really in control right now? Well, effectively, the buyer is still in control, the bull is still in control, but there are questions and concerns that lead to the bull taking profits and or the bear re-engaging when we get close to highs, even with a short to holding period. Until we get full resolution on tariffs and or maybe some positive economic indicators from, say, non-farm payrolls or something like that, it seems like the market's going to struggle to break out to the upside. But we could do it anyway, even without the inputs. It just seems less likely. So with all that said, the probability of success is more driven by, for the broad market, saying we're not necessarily going to go down. And that's a higher probability of success trade anyway than having to go higher. And if we're going to have a situation where we don't break out to a new upside high, I am more inclined to look to sell put credit spreads on dips than buy calls here. Now, I could buy calls if we break out and hold, but I still expect that anytime we get towards highs, we should have a little dip that then creates a better opportunity to go for a we're not going to keep going down kind of trade, as opposed to this is starting new momentum to the downside kind of trade. Now, if we start breaching support levels around 620 in SPY, 6200 in SPX, I guess it's technically closer to 618 in SPY to be 6200 in SPX. Then that can change. Or if we breach upside and go above 6,400 in S&Ps, that can change. But until one of those two levels gets breached with conviction, I trade for chop. And when we're in the middle of the range around 630, that doesn't necessarily give me a lot of great trade opportunities. It's more about trying to find some high probability trades that still have a positive expected value. All right, so with all that said, I think the trend continues to be chop right now. Nothing breaking out until we go below 6,200 or above 6,400. Long and short the market at the same time with a bias can work, but if we go into liquidation mode for the market, the initial move tends to be selling the good stuff as opposed to selling the bad stuff, i.e. people start to press on Apple or NVIDIA or Palantir or Microsoft to reduce risk. you don't have to sell Eli Lilly to reduce risk because there's not a lot of people out there that are long Eli Lilly. So they actually maybe end up buying Eli Lilly to reduce risk. If there's a lot of short positioning out there, that unwind can actually switch the direction until we get to a point where we breach a technical level in the S&P to the downside. Profit taking, risk off tends to come from the better performing stocks and not the worst performing stocks, since people are either not long or even short those in general. All right. And with all of that in mind, I think allowing more time makes a lot of sense, especially when I keep looking at Microsoft. I mean, I like Microsoft. I think it makes sense, and yet the market's not pushing Microsoft higher yet. So allowing more time allows for this trade to play out, which means I'm not looking at like August 15th options expiring next Friday. I'm thinking September or maybe even October at this point. September seems like it should be okay. It's about 4 weeks, 4 or 5 weeks, but at the end of the day, maybe that's not even enough, depending upon the magnitude of rally I'm looking for. With regards to allowing more space, that would generally be the case for put credit spreads, trying to go a little bit lower to increase the probability of success, but it's a balance. So if I have a 60% chance of making a 40% return, I'm a break even. If the 40% chance is a 60% loss. If I have a 60% chance of making a 300% return, then that's a great trade. Doesn't happen with book credit spreads. We're looking for 30, 40% returns of risk on capital or return on risk. If I go lower, I'm going to have a higher probability of success, but a lower return on capital. And that's that balancing act, is determining where my comfort zone is. Do I like having 50-50 with a positive expected value, or do I like having 80% winners with the same positive expected value? That's a personal preference. That's trading psychology for you 101, right? If I win 4 out of my 5 trades with a lower number and that makes me comfortable, that's better than if I'm winning 30% of my trades with massive returns on my wins. That can be a psychological impact for people. Some people like that. It has a little bit more of the gambling dopamine effect. Some people don't. Taking some losses on 70% of my trades is a painful experience for many people, even if they are seeing their account grow. There's a frustration in looking for, well, how do I improve that odds of success to 50 or 60%? Well, unfortunately, the end result is giving up some of the returns. So if I want to give up some of those returns in order to have that the magnitude of returns, in order to have a more consistent trading profile, that's a perfectly acceptable rationale, and a lot of people utilize that. But know that if every time I'm putting on a trade for like a lottery ticket, it's not going to have a positive percentage win rate. It's going to be all about the potential return. So I don't want to get into a mode where I'm putting on lots of lottery tickets, lots of 10, 15% probability of success trades, and then telling myself, gosh, I can't believe I got it wrong again. If I have 15% win rate with a massive return, but I'm only winning 1 out of every 4 trades, that's okay. I'm still making money, but I can't try to convince myself that I should be winning 50 or 60% of the time. That's not the way the trade was set up. The way the trade was set up was either to, hit a home run or to strike out. All right. Swinging for the fences in that case. As always, I don't like revenge trading. So buying Eli Lilly here is not a logical solution. Buying Fortinet, not a logical answer. Buying the trade desk after their earnings yesterday, not necessarily a good answer here. There can be some continuation trading to the downside or some avoidance of those sort of trades. In terms of like Microsoft, there's a little element of revenge about the fact that there was no continuation right now. So I have to keep my head on straight for that and know whether I'm buying just because I'm annoyed that it hasn't gone up, or if I'm actually buying because the technicals are starting to show that upside. And so I've been holding off on Microsoft. I'm getting less and less patient, but not because the trade is getting better for the long necessarily. It's because the trade's not working yet for the long. So I'm looking for that signal that the long is starting to get re-engaged, and I'm just not seeing it, and I expect to see it. But sometimes those trades just never come through. So I can continue to watch it, but I don't want to hyper focus on it when it's just not there yet. All right. With all that said, let's go over to the 10-year yield. Continuing to drift back towards 4.4. So we pushed down to 4.2, found support right at the July 1st low, tested slightly below it, and then bounced off. Economic health looking better and better apparently, and that's allowing the 10-year yield to drift higher. MMFI. stocks above the 50-day moving average. We're sitting right around the 50% mark. And this will update in 15 minutes. It's got a little time delay for bar chart, but we're right around the 50% marker. We got up to 55 yesterday with the attempt to push towards the highs, and then because of selling throughout the day, we did see some stocks pull back below their 50-day moving average. Very neutral stance, very stock picker stance. Half the stocks show some bullish momentum above the 50-day moving average. Half the stocks show some bearish momentum below the 50-day moving average. Sector-wise, a lot of neutrality right now. Or big market-wise, a lot of neutrality, and a lot of sectors are neutral as well. So keeping all of that in mind, I got to make sure that I don't try to force a trade in the wrong stock, thinking that everything is bullish and that these are going to play catch up. They may play catch up, but they may not. And if they don't play catch up, then why am I trying to force that trade? All right. Sorry, get a couple of spreadsheets open before I forget. Now let's move over to crypto. So a nice risk on barometer for us. And it tested support at 112 and resistance is at 120, and it's right in the middle of the range right now, a little bit closer to the high end of the range. So we tested the lows, bounced back up. Kind of reminds me of the 10-year yields in many ways, right? When the risk is starting to go back on and we get above 120, it can be exciting and dynamic. In this range, I'm less inclined to be too excited. Much like the S&P 500, testing a low point, 6,200, and having resistance at 6,400, we've got 112 and 120 for Bitcoin. So they're kind of going hand in hand right now, market and crypto. If and when risk gets back on, crypto can be very exciting and dynamic. If and when the market starts to liquidate, I think crypto becomes a side story, less to focus on. Crypto is a sector and a cryptocurrency, that's more in focus when it's bullish than when it's bearish. When it's bearish, if we liquidate to 100 or 90, maybe a different story. There's some excitement in that process. But I think there's a lot of long-term holders that prevent us from dropping too aggressively. They don't, a lot of these crypto investors tend to be very focused on, well, in the long run, this is going to go to $1 million or $100 million or whatever the number is. So they disregard some of the short-term movement. And that could be a good logical thought process when dealing with the investment community that's in 401ks. They're not necessarily liquidating. It's people that need cash now or need to perform. So money managers have to have performance every month and every year. If they're seeing negative performance, they have to move to cash in order to avoid outflows from their funds and prevent people from reducing their investment allocation with them. So that means sometimes their decision is made based upon risk as opposed to based upon the fundamentals of the economy. But that's the same thing that we do as traders, is we look at the risk and determine when to exit as opposed to the long-term growth potential for an active trading portfolio. Investment portfolios, long-term growth potential. Trading portfolios about the risk-reward balance in the near term. All right. I'll come back to VZ in a few minutes. That's our paid trade this week. S&Ps. So yesterday's high was 636 and change, almost 637. Today we're opening up at 634.42. So for now, I was right. I had said that I wouldn't be surprised if the market started a little bit higher today. If we go down to the 5-day chart, the overnight market showed some nice rally in S&Ps, and then we pulled back. And then we saw buyers near the close. Seemed like we were positioning for a potential for a jump back up, maybe not all the way to 637. I was thinking 635, 636 range, and we got a little shy of that before open today. Maybe we see a pop on the open, a little bit more buying. I would not be surprised to see a drift back down towards about 631, and then maybe a settle around 632, 632 and a half, maybe repeating some of the pattern of yesterday. The closer we get to 640 without a fundamental input to justify it, the harder it is to really get bullish exposure. So anytime we get close to this July 31st high of 639.85, and right now we're about 0.75% away, naturally I think inclination is for profit taking. So for profit taking in S&Ps, it puts a little bit of a temporary ceiling on any individual stock as well as the broad market. The VIX is starting to drop though. So we're down to 16.13 in the VIX. Yesterday's low was 1598. Again, if people are reducing their fear, we can get the VIX down towards 15% again, maybe even into the 14s. I gotta think that as much as I thought that 15 and 14 was overvalued here, I'm not sure I'm ready to go below that without a breakout to the upside in the market. So finalizing some tariff negotiations goes a long way in that sense. Finalizing some economic data that's neutral to bullish goes a long way in that regard. Seeing inflation data that's low goes a long way in that regard. It helps rebuild confidence that the market doesn't need a liquidation event like we saw in April and March. And I don't think we need that kind of liquidation event, frankly. And we're also trading the market, telling the market every time we dip, it's a buying opportunity, even if it seems shallow like it was for Friday. It wasn't that big of a break. People got nervous, and then investment community came back in and started buying again. And then the final element for the S&P, of course, I always like to focus on skew, and the out of the money put buyers are still there, but it looked like yesterday there was some rolling going on for the hedge. So moving up from maybe the 6,000 strike towards the 6,200 strike in the S&P 500, effectively raising up the hedge price point from being a further out of the money put to something a little bit more relevant. Taking into consideration that maybe the downside's more limited, so I need my put closer to the money, logical or not. If the purpose of the hedge is to protect against liquidation, a 6,000 put makes more sense usually. If the purpose of the hedge is to be able to stop out in case we breach nearby support at 6,200, then the 6,200 line makes sense. So when structuring a hedge, it's very crucial to understand what I'm hedging against. If I'm hedging against a bad report next week, I don't need January S&P puts. And if I'm worried about a dip to 6,200, I don't need the 6,000 or 5,500 puts. Those are life insurance. If I'm worried about short-term, injury insurance, then I'm looking for something a little closer to at the money. So I think that's also important when considering how to hedge your own portfolio, is decide, how do I want to hedge? What am I actually looking to do? Am I looking to prevent a major loss for a small drop or a major loss for a big drop? All right. And right now the market seems to be a little bit of both. Initially was positioning in case of a large drop, and now repositioning for hedging a shorter drop, a small dip in the market. You can go to small caps. They're up 1/3% today. They haven't pressed against the highs here. And again, when I go out a year, you can see small caps are significantly lower than the all-time high. So in November, we were 245. So we're 10% away. S&Ps are less than 1% away. Small caps are 10% away. Small caps continue to lag. And we mentioned XLF financials can be a good leader for small caps, and right now they're not. The other thing that could be a help for small caps, and it's just not there, is healthcare. Healthcare has not participated in this rally at all. We see what's going on with Eli Lilly stock. United Healthcare stock is prime examples of where healthcare is just lagging. There's a lot of concern about pharmaceutical pricing and everything else in the political agenda there. That seems to be having a negative impact in healthcare. We go to biotech. Biotech can be a little bit of a mixed bag because lower interest rates allows biotech companies to raise funds. But if pharmaceutical pricing is going to be impacted by political agenda items, then they could have a negative impact as well. So it's a little bit of a mixed bag for biotech, but healthcare, it seems clear, is something that is not happy with current policy shift. And that's holding back small caps. It's 15 to 20% of small caps are healthcare, 15 to 20% are financials. So those are two of the bigger elements that I focus on when looking at small caps as a result. And then, of course, tech. This is where our growth is, the growth sector, the AI, the semiconductors, the Microsofts, the Apples, the Mag 7. It's all about tech. Tech is where the money goes when it's looking for a bull market and risk on. And tech continues to test against this high. Now we're getting close to that inflection point once again. The previous high from July 31st, post Meta and Microsoft earnings, pre non-farm payrolls, Apple earnings, and Amazon earnings, was 574.63. So we're $3 away. $3.40 away. about 0.5%, a little more. Yesterday's high, 573.32, found a brick wall there because we got so close to the new all-time highs. Today's high, 571.31. Again, we're about less than 0.5% away from testing yesterday's highs. A little bit of buying overnight. Maybe we see a dip today, but the broad dip element seems to be more present in S&Ps than within tech. And one of the things that I like to look at for tech bullish indication would be semiconductors. And they're lagging a little bit today. Only up 0.25%. They should be up more than QQQs in percentage terms, about double the QQQ move. And that's not what the case is so far. Maybe that changes. But for now, a bit of lagging there. My spreadsheet's not load. They didn't load at all. Yeah, of course. All right, let me restart a couple spreadsheets just because I need to look at some other sector shifts going on this morning. One moment here, folks. I'll get this back up in a moment. There we go. But yeah, broadly speaking, semiconductors are fine. They're not exploding to the upside. Nvidia's not exploding to the upside. But we saw some weak earnings out of a lot of semiconductor names. I mean, just a reminder, we had Texas Instruments a couple of weeks ago. They were weak. We had AMD more recently. They were weak and bouncing back after that weakness. But the concern, I think, comes from understanding that, well, if these semiconductor names are weak, what changes that flow if earnings can't do it anymore? Now, we have NVIDIA earnings coming up in a couple of weeks, and maybe that's the main driver for semiconductors going forward. But that doesn't happen until August 27th. So we got almost 3 weeks until NVIDIA could potentially give a bigger catalyst for movement in the semiconductor space. And I can argue either way. I could say NVIDIA might be like AMD and some of these others where it's weak in terms of the earnings reports, maybe driven by tariffs, or it may show strength because everybody needs NVIDIA chips, and those are the best ones for AI. And since AI earnings have been positive, Palantir is a prime, the go-to element there, bullish and then follow through. These are signs to me that there is still something in AI, and where are they getting their semiconductors? And maybe that means that NVIDIA earnings need to come in bullish, and August 27th or the final week of August can be a really interesting bull week. We get bullishness potentially out of NVIDIA earnings. And then the following week, we've got non-farm payrolls for September, and that could be a positive or a negative, but we'll see which direction it goes. All right. Told you to check on Verizon real quick. So that's our paid trade for the week. A little bit positive right now, up about 1/3%. Remember, this is only a 1% average daily move stock. So it's a low volatility stock. Let me double check and see. About a break even right now, down very small on our trade. If we stay down on the day, we'll look to just exit the trade. If there gets to be some momentum today in Verizon, we'll look to hold half the position through to Monday for some potential follow through. So we're testing the 100-day moving average, testing the highs of the last few weeks. On August 1st, which was Friday, the high was 43.47. That's a little bit of a lift here. That's about a standard deviation move to get there, but we may press against that and justify a potential for a hold to see if we can push to 44.5. And a move to 44.5, by the way, in Verizon creates a very leveraged return because it's such a low volatility stock. So we'll continue to watch the money flow. It's been very choppy, a lot of up and down, then up and down, then up and down, not really going anywhere. So getting out of that range would be really dynamic for it. But it requires some money and some interest. And right now it's just not aggressive interest. It's just showing some of the first signs of it really between yesterday and today. T-Mobile, by the way, within that telecom space is looking a little bit more dynamic today, up above the 100-day moving average, has a less tight coil. AT&T is another one that I look at for the telecom sector, and that looks like it's gotten a little bit of money flow today as well. So telecoms may be starting to come back around. We'll see. If they do, great, we can get some nice profit off of that. If not, I expect to be pretty close to a break even in that trade, which if my losers are close to break even and I've got a potential for a dynamic return, that's a great thing. We've seen some good general results for paid. Last week was a bit tough because of the Friday non-farm payrolls, but overall, continue to look for those dynamic market shifts, and perhaps telecoms can be one of those sectors that pays off for us today. And if not, we'll reevaluate next week with a bunch of new ideas. So light this week, given Friday's action last week. Didn't know how things were going to play out this week, obviously. For aggressive power trader, we talked about Microsoft. That's on the list. For me, it's all about the bull flag. So I need to get at least a higher high and higher low here. We're not there yet, 528. If we can get up another $5, I know it's a whole percent, and that's a full standard deviation move. That starts to give me a signal. In the meanwhile, support around 515 can justify a put credit spread in the near term. So the 515 level allows for a 50-cent put credit spread, decent return on capital. The 20-day moving average is 515.53, and you can see along this bull trend, we have not breached the 20-day moving average. So if we breach the 20-day moving average, look to exit. The put credit spread probably goes to about $1, $1.20 range. So risking 50 to 70 cents to make 50 cents. High probability of success, equal size risk and reward, roughly. So as long as I've got a 70-ish or 80% chance of holding support, which I believe I do, I think the Microsoft put credit spread is the right answer right now. And if we shift into bull mode, Microsoft shifts to a long call play. Let's just check and see where Apple's at today. Up another 45 cents. That seems like it may be now fully digesting a lot of the news this week. We were looking at that for a put credit spread early in the week. Put credit spread worked. It turned out a call worked better, but now we're bumping against some resistance here at the 200-day moving average, starting to consolidate post move. Perhaps we get follow through, perhaps not. For me, I don't have a strong opinion on Apple at this moment. We've had a big run, and we've had these periods of consolidation. So now that everything seems more fully digested, I'm not looking to do anything crazy in Apple. Let's go to yesterday's earnings. I highlighted only two. The trade desk more to watch than to do anything. I'm glad I didn't do anything because, frankly, this was a massive move. So biggest move we've had in 2 years, right? Big moves normally were 30%. This time we dropped 36%. Really poor earnings, unfortunately for them. It makes this a less interesting stock for, I think, a while here. The last time we had that bad earnings, we did drift down for a while before finding finally some bullish action into earnings that was justified, but then we drift down with profit taking before rallying into this earnings and then dropping back down here towards the April lows. So for me, not much to trade here with Trade Desk. But I think this was a prime example of one of those stocks that just, it can be way too whippy to justify a major trade. Pinterest looked better, right? And I mentioned that we were looking for 33 as a price target, and we touched it, and then we bounced back off. And on the upside, we were looking at 45. Obviously, we had the bearish earnings. So again, it goes back to the dominant focal point for the trade looked to be on the bull side for 45, but a hedge trade with a put butterfly and a call butterfly certainly significantly better. Now in this case, small losing trade at this point because I was looking at the 35.5, 33, 30.5 put fly, which is now about 50 cents. Need to see a little bit more follow through to the downside in order to get that back to a break even or a profit. But given current money flow, that's it's a questionable setup right now. Retesting the lows, home run. That's where it would have been perfect. But now with the bounce back, sometimes just don't get the full money flow the way that expected. And we bounced off of it, and somebody still wants to buy Pinterest in spite of poor earnings here. So again, that was looking at around that 15% expected move for Pinterest. We ended up now at 8.5%. So we may see a dip back down to get to closer to the 33 level, or we may see a rally back and end up settling around 5% down, or we may do nothing. I don't have a strong opinion on where we go from here today. So it's just about the risk reward. Is the 35.5 put for 50 cents on its own a worthy trade? 40 cents now, I suppose, for mid-market, 45 maybe. Is 45 cents too much for that put? I don't think so. If it gets to $1, yeah, it's probably about all I would want to take on the risk. So, holding it for a little bit and seeing a 50-50 shot of it turning to $1 or turning to 0, that's the determining factor. It may go to $2.5, but if I'm going to take my profit, if it hits 70, then I probably should take the stop right now. If I'm going to wait it out to see if it can go to $1.50, and I think that that's the accurate price target, 34 range, not quite to the lows, then I'm okay holding if I think that's a coin flip of up or down. So just recalculating, re-examining the expected value of the trade intraday is the key. And if the expected value of a trade at this point in the day is negative, then taking the small loss is better than taking a full loss. If the calculation leads to a expectation of making money from this point, holding makes sense. So got to watch and see. I think that, within the next hour, we'll know for sure, or we'll know with better confidence here. Getting back below 34.80 would be crucial for the bear. But of course, by that point, we may be at a point of saying I need to take some profits because the expected value has shifted. So it's just a very dynamic trading opportunity here. I do still like the bear side because of the bearish earnings. But once we get to 80 cents to $1 on the put fly, I think that that's probably a better point to look for an exit as opposed to trying to squeeze out extra return. Okay. Yeah, so Fred, yeah, that's Verizon now actually getting a little bit more up a penny now. Yay. I think we were at around 69 cents on these September 44 calls. So a little bit of an implied volatility hit today. Oh, I forgot to check on this. Excuse me. So there was big volume yesterday on the September 45s, good call interest, and it was a drop in the OI by about 1,500. So the seller there looked like they were exiting some of the 45 calls. Maybe less exciting than my original hope of seeing a building position to create a greater size magnet there. So when the open interest starts to drop, it reduces that magnet effect. When people are selling calls into the rally just to reduce their exposure on long calls, it doesn't necessarily expose us to expecting high return profile. If people are initiating buy rights, selling calls against a long stock position, that's good. If people are buying calls outright, that's good. When they are selling out their long calls, it doesn't necessarily add to the confidence of the upside potential. But at least so far today, we've got a little bit more bounce here. And I do like the way that it is holding now above the 100-day moving average. So we'll see how it goes through today. Again, I think that this 43.5 level is going to be key. And if telecom money flow continues on the positive side, that should be achievable today with a potential of even getting up close to 44 or 44.5, which would be a very dynamic move for Verizon. So keep that in mind. If we get a dynamic move of $1, that's a dynamic move. We'll see how it goes. All right. Yeah. From there, let's go to, what do I want to check on? Oh, NVIDIA was the other aggressive power trader name. So testing the highs, maybe on a breakout, it can get some continued money flow before earnings. Because we only have 3 weeks, I'd be looking exclusively at the August 22nd options, give myself 2 weeks. That doesn't give me enough time to play a bull trade. Right now, being that we're testing highs, I'm not sure I want to do a put credit spread. We may be just a little bit too much threading the needle with a put credit spread for 2 weeks, arguing for a stay above the 20-day moving average. if there's any shift or money flow coming off the table heading into earnings, that may actually lead to it breaching the 20-day moving average. So I'm a little bit hesitant on this, but the return may be best suited for looking for a slightly out of the money call spread. It's not hugely dynamic. Again, 220 for something that maxes out at $5 with an 182.5, 187.5 call spread. It's a tough one for me right now. Others may see something more interesting, maybe with that put credit spread for 175, 172.5 put credit spread, which right now for next week is, come on, update my prices, about 30 cents. That's not really enough for me. For others, it may be. For 2 weeks, it's 50 cents. I think the better put credit spread still lives with Microsoft. And then shifting Microsoft towards an outright call if we get above yesterday's high. But I would actually prefer at this point with Microsoft to hang in this area and then on Monday start showing higher high and higher low than today, and really start to show me that that is building and I can get in at a little better price. Because if I wait for yesterday's high, now I'm already up 1.4%. So I'm up more than a standard deviation in Microsoft stock price. And that starts to get a little tougher for me to chase into. It may be the beginning, it may just be a short-term blip in that scenario, and I think the odds of success start to drift down. And when you look at the forecast toolbox for Microsoft, that 533 is the expected potential high for today. And right now showing a lot of neutrality. So put credit spread maybe makes more sense. And if we start to shift towards that high of the day and close around 530, sure, maybe the model starts to update much more bullish. But in the near term, the return doesn't necessarily look that great. Caterpillar, question mark for me. That's another big part of the IWM is the industrials. So like when the Dow Jones Industrial Average is bullish, that actually does sometimes look good for IWM XLI, the industrial sector ETF. These are still showing some bullishness, but not to the extent of the broad market. It looks a little bit more like XLF, although XLF is slightly weaker. I'd love to see some more money flow back into Caterpillar and look for a potential re-entry there on the bull case. But for now, Caterpillar is got a lot of overhead resistance at 440. And that is 4 or 5% away, so that is 3 standard deviations up. So there is some return on a trade for with a long call shooting for 440 in the next week, for example. But if it takes a month, not a lot of return in that trade, unless going with a call debit spread, or again, kind of looking back at that put credit spread and thinking about, well, 400 is very safe. Do I get enough premium to sell 400 put for next week? Not really, 17 cents. If I go another week, do I get enough enough premium? 31 cents. Could be questionable. About a 15% return on capital, but I got to hold it for 2 weeks. So, yeah, and if you're more aggressive, like a 420, 415, like you mentioned, Fred, then that may be what is needed in order to really get a return. I'm a little hesitant with the 420 because yesterday we got below it. Maybe aggressive would be a 410, 407.5 or 410, 405 put credit spread. And that for next week is about 43 cents. So we're getting a little bit up there here. For the following week, it's about 60 cents. Now we're starting to get some real return. And I don't need a 90% probability of success for that trade to work. I need a 60, 70% probability of success, because I'm not letting that go to the full loss of $2.50. We get below 410, I'm out, and that's going to be worth $1.25. So if I get a quarter of the max spread value, exiting if it gets to a half of the max spread value, and managing the risk that way, then I have a 1-to-1 risk versus reward, and a higher than 50% chance that we hold that level, right? So we'll see what happens, but I think that may be the logical approach for Caterpillar in addition to Microsoft at this point. What's the forecast toolbox saying for Caterpillar right now? Speaking of which. Very neutral, slightly bearish. So we'll see how that updates over the weekend if we do hold this bounce. Because the expected close today was 417.5, which would not look great for a put credit spread given that we're at 421 right now. But if we hold on, I can kill this filter. I'm not looking at those anymore. If we can hold on and start to show some bullishness and holding these levels near the close, then I think the toolbox update will look a little bit more neutral to bullish on Monday instead of currently looking light bearish. Now Apple's following through. So apparently the digestion isn't quite complete as we're up nearly a whole standard deviation. So full standard deviation is 1.5%. We're up about 1% today, getting closer and closer to doing that above the 200-day moving average. People like Apple again. And so after disregarding it for months through the whole tariff news, now that they don't have to build everything 100% in the United States, I suppose people have found that relief and they're willing to let Apple participate in the market rally. Maybe it does mean that Apple needs to go to 250 and participate the same way that these other big tech names in the Mag 7 have done so, right? Should note on Meta, much like Microsoft, it's not making the new high, but much different from Microsoft, it's not pulling back. With Meta, another one that looks for me at the short term to be a put credit spread, this time it's the 750 line, so $12 away, which is fairly a standard deviation. But we'll see if the premium justifies it for next week. And 70 cents, I think it does. So similar to Microsoft, the return on risk is pretty solid here. It's more than a quarter of the max value of that spread. And I have pretty good support there at 750. I also have some big open interest at 750. So that can create that bounce off where it could create a magnet, but it should create at least some interest and inflection point trading around the 750 line. So Meta does become somewhat interesting from that perspective. We'll just have to see how it goes. In terms of sectors moving today, it's XME, it's XLE, it's commodities. So it's, XME, which has a lot of base metals in mining, as well as the gold miners in mining. Gold's not moving today, unchanged. Silver up about 1/3%. Let's go to silver here. So the XME is breaking out, silver is lagging it a little bit, and gold miners, here we are, breaking out. So people are looking at this and thinking that there's some good margin apparently for the gold miners, even without gold breaking out to a new high. I do tend to wonder why hasn't gold been the driving force behind this? Usually I see gold running first and miners running second. But maybe these companies just have enough fundamental input to get them going without gold spiking. A little bit of a disconnect. I think if I'm looking for a bullish play within the metals, I'd go for silver over miners because they tend to be highly correlated. XLE is another one that's moving up today, up a little over 1%. But you can see when we look at the chart that 1% seems pretty inconsequential. We're just bouncing off the lows. Nothing major here in terms of a trend shift. I mean, really all it comes down to for me is looking at this and saying, well, 84 is continuing to be our floor and I'm back to put credit spreads. I see that as my kind of general theme here. Not a lot of stocks that I can consider to be particularly bullish, but an 84, 83.5 put credit spread for 9 cents. It's not too bad. I'd be stopping out if it got to about 20 to 25 cents. I only have to have it stay above 84 for a week. 84, 83 for 16 cents is somewhat similar if you want to widen out the strikes just to get a little more return instead of doing twice the size on the 84, 83.5. A lot of that comes down to commissions and fees. If my commission and fee structure means that I have to give up a penny in terms of commission and fees, then now I'm only collecting 8 cents instead of 9. And if I want to exit it for a penny, I'm going to pay 2 cents. So now I'm only capturing 6 cents of profit after commissions and fees. So that comes into hyper focus when dealing with these really tight put credit spreads. If your commission and fee structure is such that it's a lower expense, and or I don't feel the need to actually close out the trade for a penny, then I'm much better off than if I have to pay the penny plus the commissions and fees to get out, and I have to pay those commissions and fees aggressively on the entry point. So have to widen out when commissions and fees start to become the dominant portion of the return on the trade. No, I didn't see that downgrade. So yeah, if the downgrade on Caterpillar was done and the stock is rallying out of it, the element that I usually look at that and say, okay, well, if a downgrade comes in and we don't sell on the downgrade, then maybe people were expecting worse news or a worse downgrade, and so it's not as bad as expected, and that means we can drift back higher. S&P's now driving up to being one of the best performers today, up $4. So testing yesterday's highs now. Here we go, 536.98. I don't see a justification for a new high today. I mean, I think frankly we're getting real close to a good profit taking zone. But if QQQ is driving this and we get this new all-time high, which right now we are $2 away from, we are above, and now we're below yesterday's high. We didn't quite get above yesterday's high. We're getting real close here. Thank Apple for that. Thank Tesla for that, up 3%. Some of these elements are showing that there is some interest in buying right now, maybe saying, the bear needs to be fed and we're not getting any new bearish inputs. So the bear didn't get fed on this one. They got a bad day on Friday and then a lack of news to continue shifting the market lower. So without anything that drives it lower, the natural flow tends to start to be higher. And if people had reduced positions and don't want to miss out, they start buying now. I still think logically that it's going to be tough to get above 540, but to be determined, right? Verizon just kind of hanging there. All right. I'm hopeful. I would love to see an upside move, Fred. I'm not excited about it yet because I want to see it, but I'm very neutral on my portfolio right now. I don't have anything leveraged for it, but that's because I shouldn't, right? If I don't believe that 540 is just going to get taken out, there's nothing telling me that 540 is going to get taken out yet. But if we do it, I got to react to it. So I got to be prepared with what I'm going to do if. And I think if I'll just kind of go to some of my big names that that I like in this kind of market environment. Maybe it's NVIDIA. Maybe I go back to some financials and just look straight at JP Morgan, one of the better performing financials out there. And I may be somewhat wrong in my stock selection, but these are names that I tend to like that look like they have limited downside and should have limited downside and maybe get more participation if there's a just general tailwind for the market. Or I go back to, forecast toolbox and I look for big names here. So if the market's going up, big names that have a high correlation to the market is going to be key. So, go to my A's and B's, look for some stuff with a positive vector. I mean, eBay's been on its own, moving up. Maybe Western Digital, maybe Marriott. Often like One Oak. Seagate, there's another one that I tend to like here. Walmart, what's Walmart up to now? That one took off. Yeah, and just continuing here. Did not see that coming, personally. Earnings in 2 weeks, I did not see that coming where we were going to get the jump from 100 up to 104. I thought that we were going to see that resistance hit. Walmart just keeps going. But let's see here. eBay, more continuation. I think that 100 is a tough level for eBay to get through with too much ease, but eBay could be an interesting one, getting back above yesterday's high around the 93.5 level. Good looking prediction there. Western Digital currently looks more like a put credit spread based upon the forecasted range, but had positive earnings. And maybe this is the formation I was looking for in Microsoft now that it's bouncing off the 10-day moving average and we've got the bull flag, higher high, higher low, resistance at 80. That might not be a bad one. Go out to September just to give myself some time. and look for a 77.5, 82.5 call debit spread for $1.45. A little more leverage, but not necessarily going straight outright call yet. Marriott, too choppy. One Oak, the power companies, are they? Is there anything about that chart that I can love? Not really. I mean, it's a bounce back to 81.5 kind of trade, similar to what we looked at in Kroger, I think, last week. STX, that's interesting. They're looking bear side of STX. Let me double check that chart. I haven't looked at it in the last 2 days. So we had the negative earnings, the bounce back, the rejection, and then now bouncing back off of these lows around 145. So resistance at 157. But if we get a breakout in the market, I wouldn't be surprised to see STX take off with it. So yeah, it gives me kind of a short list going through some of the higher model probability trades, maybe disregarding STX, focusing on eBay, even though that's not high correlation, focusing on financials because they're now starting to become one of the leaders of the day. Financials and S&Ps starting to become the best returns of the day in terms of standard deviation moves. So there's money flow there. Maybe this is shifting back into that stuff. Yeah, thank you, Fred. Appreciate that. When as you start to look at a number of names every day, I mean, I know that there have been periods in my trading career where I say, oh, I just need a week break from the market. And if you take a week away from the market, whether it's a vacation or something else, it does take a couple of days to kind of get back into, okay, well, where's the money flow really going? Because I got to reevaluate what happened on the last week. So I do think that one of the big things with market participation when actively trading is knowing kind of what's been going on the last few days and kind of remembering that, writing it down and saying, okay, well, where was the money flow? What is the driving factor? I mean, I still have, and I shouldn't have, but I still have my Schwab calls. Probably shouldn't. They expire next week and they're unlikely, but maybe this financial bull market gets my August 100 calls back into play. Probably too cheap for me to sell them right now. I should probably be in a call debit spread. But every once in a while we all get a little bit lax with certain positions. I should have exited those Schwab calls ahead of non-farm payrolls. I didn't. Now I kind of have a little bit of a hope trade on it, but I do think that there's a positive expected value for it. May not be the perfect trade, but I don't want to pay all the commissions and fees in the market spread to modify my trade structure aggressively here. If it gets above 97.5, honestly, I simply just look to add with a September call. So even if my $100 call in August doesn't work out because I run out of time, doesn't mean I want to completely ignore that trade. This one was not like some of my other hate trades where like Micron months ago, nearly a year ago, I got kind of wiped out by it, or wiped out on the trade. So I didn't want to trade with it anymore. Or like HUD 8, I had a lot of chop within my trade there, and I think I've ended up break even in my HUD 8 trading for the last 6 months, but it's been a lot of chop and frustration along the way. Down 93 cents, and Bitcoin's down now. That's why. So a little money out of Bitcoin and into the market today. Down about 40 cents. Interesting. Yeah, we'll see how that goes. I mean, effectively neutral day to day in Bitcoin, but you got some money going out of the crypto names, Riot, etc. MSTR is getting a little bit of money flow again today. Maybe that continues to shift higher, and you got to stay big. All right. XLF. Yeah, I mean, the names I've watched most closely within XLF are, of course, JP Morgan, and that's looking better and better here. Above that 10-day moving average, it looks really good, but that's 2%. It's hard chase. Maybe Citigroup's already there. No, not quite. Wells Fargo. Wells Fargo could be one, maybe better than JP Morgan. Stability and, you know, a little more housing exposure with more mortgages. You know, we mentioned Morgan Stanley. That looks better than JP Morgan right now. Maybe Morgan Stanley is the better avenue for within the financials. Bank of America looks a little more like Wells Fargo. I just like Wells Fargo better. How about the regionals? Regional lagging a little bit. Yeah, I think right now the market's telling me Morgan Stanley is probably the best to start with. And if I miss Morgan Stanley, I look at JP Morgan, Citigroup, Wells Fargo. And then if I miss all those and the XLF rally continues, but then I have to start looking at those regional banks. BRKB. God, I have not looked at BRKB for an actual trading opportunity. Back in the day, I was a market maker for the options in BRKB. But that was dating myself 15 years ago. Yeah, it was back in 2011 range, I suppose, because it was about a $75 stock. Yeah, so that looks about right. Back in 2011, 14 years ago. All right, it's not as long as I was thinking. It got pretty wild because the options were just really getting dynamic there after they became an $80 stock versus, like, you know, the Berkshire A shares, where you can't make a market in a $700,000 stock. I don't even think they have options on it. If they do, they're crazy. Yeah, they don't. BRKB does, but, you know, that's a different kind of stock out there, you know. Major holding company. They got a lot of stuff to deal with for BRKB because of the of Buffett's impending retirement, and that's putting a weight for the last few months on Berkshire. But I got to think that's fully digested. And now it's just a matter of seeing some results from the new leadership team there. I don't see anything else really moving majorly today that is of great interest. I'll just touch on real quick earnings for next week. We got, who cares about Friday after the close earnings? Nobody ever does anything. Monday's boring. AMC, who knows what that's going to look like. Tuesday morning, boring. Tuesday afternoon, Rigetti, CoreWeave, those could be interesting. That's Tuesday after the close, so I'll touch on those next week instead of right now. But given IONQ, their earnings were slightly weak, but generally unchanged since earnings. I'm not necessarily looking for Rigetti to have explosive earnings, maybe more of a consolidation given what IONQ did. We'll see how it goes, but I think that's something to potentially watch afterwards for those quantum computing stock interest levels. And I think quantum computing is another space that if we do start to break out to new all-time highs, people may chase into that for some high beta, high growth potential. So I think they're always worth watching. And Rigetti right now is closer to a breakout, but with earnings next week, IONQ is the bigger name. And so may just be the first to get that big move. Yeah, CELH, Celsius. Bullish earnings, higher high, higher low. People still like it. What did we do in February? Fade. Over the last couple of years. So these two earnings, we had bullish earnings with some follow through before fade. Here we had bullish earnings and immediate fade. I think the general pattern here is that at some point post earnings, it's going to fade. It's just a question of how high we go first. Guess toolbox for it. Curious would may not have a good model grade. We'll find out. Yeah, no model grade. there's a continuation expectation, but the model grade being NA, I can't be heavily reliant upon it. I don't know, just pure technical basis, get below yesterday's low and I get nervous. To at least fill down to 48, the pre-earnings high, and maybe potential for just this trade being over. So, you know, the bull, I think, could be long here, start with a 49.77 stop, and then every day just looking for a lower low as a potential exit point. And if that's too aggressive for you, then it may not be the trade for you. It's not really the trade for me, but I can see a rationale for pushing for a little bit higher prices in the next week. Beyond that, I can't say for sure. Yeah. Sorry, nothing major there on it. I mean, not enough premium way down at the next support level to sell a farther up put credit spread. Maybe a 49.5, 49 for a dime, but yeah, again, it's kind of like, it's just picking up pennies in this sense. And, you know, if we rally to 56, so yeah, I make a little bit of money, but I don't know. The best trade there may just be long stock with a 49.77 stop, 49.76 stop, you know, say we get a couple cents below 49.75 stop, something like that. All right. Well, that's about all I've got for today. I don't know if anybody else has anything. If not, I will let you go early here on this Friday and get ready for a hopefully enjoyable weekend for everybody. Oh, Verizon giving it up. Yeah, drifting back down here. Continuing the chop. Not showing aggressive. I mean, a little bit of volume here, but we're still only talking about a couple 100,000 shares. Somebody needs to get, I mean, there's no volume on this range right here between 43.10 and 43.32, a lot of little trades. So need to see somebody go for telecoms, it seems, to get Verizon going. And so maybe that money flow has to go through XLC. And XLC is consolidating here. But if you can get above these highs, you know, double up the move from today, that would naturally start the Verizon setup. But I think then that the potential momentum comes on Monday. So we test the highs today. That's great, holding half. We don't test the highs, then maybe the timing's just not right, you know? But we'll see how it goes. Hopefully it's hopefully we get the test of the highs today in XLC and push Verizon up a little bit to maybe get it on people's radars for Monday morning, or show a sign that people are starting to build up the positioning there again. All right. All right, guys. I'm gonna let you go. But like I said, I hope everybody had a great week, and I think we're getting into a little bit more technical focused market again, even though there's some underlying or overhanging fundamental inputs that we're all waiting on. So we'll see if those shift that focus back again. But for now, technicals, just, you know, monitor the previous highs for profit taking. And if we do burst through, maybe we're setting up for a short-term technical bull market, or predicting a fundamental input to put us into a bull market, which may be as much of it as anything is people expecting bullish input that's not there yet. All right. All right, guys. Again, have a great weekend. I'll see you next week. Fred, I am not, I believe the closing bell today is canceled, but we'll have an email out to confirm. I'll double check with Vlad. I think that there was no closing bell today, but if there is, you'll definitely have an email letting you know to jump on. But I think today, just the morning bell. I think Vlad was busy today, so, which is why I'm on the morning bell. So thanks again, everybody, and we'll chat next week.